Hello, everyone. For those who just logged on, my name is Dominique, and I have the rest of the Greenleaf team here with us today. Today, we will be conducting our end of quarter reviews for our commercial and retail portfolio. But first and foremost, Greenleaf hosts weekly live streams and private connect events every Thursday afternoon with a new topic every week, highlighting a portion of our business. Private events being more interactive, while live streams are open to the public. So before we dive in here, we want to provide you with some rules of engagement. First, you have the option to change your presentation view. Feel free to switch your presentation to attendee to speaker spotlight, or you can click and drag and make our presentation bigger or smaller. There will be a Q&A portion at the end of this presentation, but you do not need to wait till the very end to submit any questions you may have. You can click the Q&A button located at the bottom of your screen to submit any questions, and our team will be sure to answer those. This is also a friendly reminder that this live stream is recorded, and we will be sharing the recording link with you by the end of the week this week. We have on the screen here our topics of discussion and today's agenda. First, our panelists will share some market insights with us, and then we will dive in and discuss the portfolio's current occupancy. From there, we will shift to our cash flows and reserve positions, which will lead into our distribution discussion. Our panelists will then close with our valuation and strategic direction moving forward. That will be the end of our scheduled program, and we will move into our question and answer portion of this live stream. Well, without further ado, I will pass it over to our panelists, Dave Codre and Josh Friedenson, to begin our end of quarter review.
All righty, thank you very much, Dominique. Thanks for joining us today. We appreciate you tuning in here. We've got three main items we're going to go through before we get into all of the deal specifics. And we're going to touch base on kind of what we're seeing with essentially inflation, really supply and demand as well, business growth. And we talked about this a little bit last quarter, but how we're using data to identify value. If you've been on some of our triple net presentations or retail deals that we rolled out recently, we talked about this as well. We're going to dive into that after we cover the first 2 points here. So going into the inflation or money supply, we're seeing a lot going on right now with the prices rising. That's kind of like everywhere you're looking. So we have this chart here. This is the M2 money supply. This is something, if you look back in the past years, obviously it was increasing. This is kind of total cash credit that's in the market. So we've had a little bit of a bump here since 2020. It's up about 25%. And that's a lot of the reason why we're seeing prices increasing across the board. And it's doubled since 2010. So we really started investing heavily in real estate in 2010. And since then, we've seen this kind of path and growth of really inflation and driving asset values up. If we look at M1, and M1 is just current cash that's in the market, and this is really the impact of stimulus that has come out since really at the end of the Trump administration into the Biden administration. We keep putting out more stimulus into the market. This is coming from the St. Louis Fed. That's where this chart is from, and you can see a pretty huge spike here at the end of this chart. What essentially this looks like is we had about 4 trillion in money supply, and now we have 19 trillion. So fairly rapidly, the government put about $15 trillion worth of cash into the economy. And people I think it takes a little bit of time to spend $15 trillion. I don't know how fast you can do that, but we've certainly been spending it over the past year or two here. And people have been really doing a lot of investment with that, and that's driving up asset prices pretty substantially.
Yeah, I mean, we had a good discussion with our lenders that overnight, when stimulus checks hit their accounts, all their clients, got their stimulus check, and overnight they had an additional $50 million of cash on hand, which basically put them out of compliance.
This is at a bank. This is at a bank.
Yeah, at a bank, and put them out of compliance with all the regulatory authorities of how much basically cash they can keep and how much they have to lend out. And so within a week, we got a call saying, hey, your guys' $15 million lending limit is now increased to $25 million. We're dropping our rates from 4% to 3.25%. We need to get money out the door now. Please buy more properties faster. So that's
I know we probably weren't the only person they called to ask that. So with this just spike in M1 and that pushing cash out there in demand, and not only trickled through, you hear a lot about hey, everyone got a $600 check. It's not $15 trillion in $600 increments. It's banks that got $50 million that are now, hey, we're going to go deploy this. And this is just a local community bank. This wasn't like Wells Fargo.
Right.
This is a tiny bank in grand comparison to that. So we've seen that. I mean, that's why also in the past year, all the loans we've done, we've gotten the best rates we've ever gotten.
Yes.
So-
And really in the immediate future, they still have more cash than they know what to do with and want to deploy it at low rates. So
Yep.
we're in a really good position as we kind of wrap up the end of the year here.
Yeah, so we look at the money supply that's into the market right now. So it's driving up replacement costs. Everything's costing more to do, but it's also driving down cap rates. The only real thing we're finding here is that there's value between stable and a producing piece of real estate versus a defunct piece. There's a huge gap right there.
Yeah, so a property we just bought last week was a 40% occupied medical office building. And in a market that medical office trades for $280 a square foot. We were able to buy this property for $200 a square foot. And it had leases on demand already. So we basically could pay for the tenant improvements, lease the property, be all into it for about $220, $230 a square foot in a market that's occupied properties are trading at $280. So a lot of that we're going to talk about kind of our future pipeline and some of the opportunities is really well located office spaces that are kind of behind the curve on occupancy because the landlords are not investing into the tenant improvements. And I want to talk about our reserve strategy and kind of how we look to capitalize on this. And that's the biggest opportunity we see looking forward in the market.
Yeah, and we have our kind of 3 strategy points up here. It's, we've always been focused on buying stuff below replacement cost, but that's a whole lot easier to do right now. So it's not just a blank and like, oh, we're buying it for cheaper than it costs to build. Everything is cheaper than it costs to build right now. And the other part is this gap between performing and non-performing assets. And the bank lending part, though, like the example for the bank that's got $50 million and they want to lend that out, they do not want to lend that out on a construction deal or a renovation deal. They want to lend that out on a stable deal. So it's still back to kind of our business plan all along was always buy stuff that's kind of defunct with not as great debt and then go get better debt once it's stabilized. We're very much seeing those opportunities existing in the commercial space, whether that's a medical tenant, whether that's a government tenant, whatever it is, we've been able to find those opportunities right now.
Yeah, and Johnson Square, which a lot of you guys invested in, that we closed in January, was a great example of that. We put the property under contract. It was 60% occupied. During the contract period, we committed to paying for all the tenant improvements for leases that were signed. And because the management company had that commitment from us, when we closed, they went from 60 to 85% occupied, literally just in the contract period.
Yeah, we started Johnson Square at 68% from when we got to it and took it up over 80% in a 5-month period. All right, so we're going to dive into, there's been lots of discussion on like, what's the different kind of post-COVID growth or what is the recovery? If you watch CNBC, they've got all sorts of shapes. We could have put like 40 different letters up here of the different shapes, but this one that touches home for us, kind of that K-shaped recovery. And when we apply that to what we're seeing in the commercial space, it's really a different story between types of businesses that have done well and types of businesses that have struggled through COVID. Our portfolio as a whole, right now we're kind of past that impact. Anyone that had an issue, that was weeded out like over a year ago. That was weeded out in like the March to June timeframe of COVID. So of 2020, that is, not this year. So that was all last year. So this K-shaped recovery that we're talking about here is like literally 2 different types of businesses and how they're doing.
Yeah, absolutely. So, I mean, most people have seen this K-shaped recovery talking about kind of the haves and have-nots, right? The haves have a lot more now and the have-nots have less now. We're seeing the same, to Dave's point, we're seeing the same thing happen with businesses that e-commerce, logistics, medical businesses with hard assets really have grown more and taken more market share away from small businesses and brick and mortar type of retail, et cetera, et cetera. So we're we're following that same trend and aligning our business with the tenants that are taking more of the market share and being a lot more cautious from the tenants that are losing market share.
Yeah, sometimes we're good predictors of what's going to happen in the world. Sometimes we're not. I guess, who knows? One of our bigger tenants, though, is LabCorp. We have about maybe five, or they're probably in 5 or 6 of our complexes right now. And obviously a very big public traded company, medical based. And I think their earnings are up 40%.
Yeah,
Like
they've had an incredible quarter.
They've done phenomenal, but they're not the only lab company in the country like that. Who knows how many there actually are. There are a lot of them. They're just one of the largest. So they've done very well. They've been a great tenant of ours. So we're excited about that. We like finding other medical deals that they're in because we know that they're a good tenant. But if it was like a mom and pop lab company, that's different. There's not as much value placed on them.
And the interesting thing, specifically about LabCorp, if you listened or read their earnings, their business overall was up. The COVID testing enhanced their business, and it wasn't planned, it wasn't expected for them. But one interesting piece of information: LabCorp processes 54,000 COVID tests a day right now. So that was a mind blowing number to me. And they're just one subset of the market that's processing this test, and how big of an impact COVID is having on the greater economy.
Yeah. All right, so let's take a look at a little bit about data. So this slide here, this is an organization. One, you're going to look at your phone after you hear about all this stuff and be like, wait a minute, what, do I like this phone or not? But Placer AI, every time you use your phone, if you use Google Maps, or if you pretty much open any app or even turn the thing on, it's recording where you are and everything. It's recording everything you do. So Placer AI, there's a few companies that do this. They aggregate that information and then display it on a dashboard, and then enable you to granularly look at that in multiple different presentation modes and pieces of data. So we can understand a multitude of points about any location that we want to look at. So we're going to run through an example of just how we use this real quick, and it applies to many different aspects of our business, especially in the commercial side. So if we look at one brand, and we look at, so this example is Dollar General. You all know we're pretty bullish on Dollar General and what they're doing, but we have 2 different maps right here. And this is kind of maybe where information was in 2015. And you could see like, oh, I can see where people are. Sort of helpful. Maybe from this you could tell on the right side here, we have Statesville, North Carolina. You see the map is a little more zoomed out, and then people coming from further distance to go to this Dollar General. And the Dollar General in Hickory, North Carolina, well, it looks like they're more condensed and they're coming from a closer range. Our old style of underwriting is we drive both of these locations. We look at traffic counts, population growth, and see what we think. Is it a good store? Does it look bad? What does the manager say? And those are kind of subjective opinions on what we think. So what we're able to do with the cell phone data now is really see like, hey, how exactly is the store doing? So we can now see the number of visitors in each store. So this tells us a different picture when we look at Statesville, North Carolina versus Hickory. So across the US, Placer is not perfect. No data set is complete, so to speak. But this has about $15,000 store locations.
Yep.
Right. Oh yeah, so they're all Dollar General locations. They've got 15,000 of them. We know there's roughly 17,000 Dollar General locations, so they're not all in here, but 15,000 is a pretty darn good subset. Of those 15,000, the Statesville Dollar General is in the top 74% based on purely foot traffic coming in and out of that store. Whereas the Hickory one is the bottom 12%. Now, these deals are trading on fairly similar cap rates, but the Statesville one is clearly a higher performer. And all the way down to, we can look at that at the state level, we can look at the local level. So within 15 miles, the Statesville Dollar General is in the top 80%, whereas the Hickory one is in the bottom 5%. So we won't be bringing you deals that are in the bottom 5% of a local demographic as an opportunity. So this helps us weed those out and enables us to make more proactive decisions. And we look at kind of like the bell curve as a whole here, and you can see that this is what all of the Dollar Generals look like. The Statesville one at 74%, and then the Hickory one at 12%. So we're trying to buy on the right side of the bell curve, and the placer data really helps us identify this. So if you do have any questions on this, we can certainly dig into it more. I'm sure that's kind of a fire hose of information right there on how we're looking at this from an underwriting standpoint. And then especially as we look at how does this apply to medical or office deals. So in that example we gave, it's easy to compare a Dollar General to another Dollar General and say, hey, this one's better or worse. But how can we use this data to guide our overall strategy and overall decision making? So this right here is the Crossing Center 2. And we
bought it last week.
Yeah, last week. Well, close this. We're actually we're sitting in a Crossing Center, some other number. This is the second Crossing Center that we bought, and it's a suburban.
Yeah, it's a suburban office in East Cobb. It's about a mile down the street from Johnson Square. We sold L28 Ridgewood and used 1031 exchange money to buy this property. It's 85% occupied right now, on a street that's 95+% occupied with growing rents, and we're experiencing that at Johnson Square. So we were bullish on the property, and this data really helped tell it. We had a theory that people are returning to suburban office much more rapidly and much more comfortably than they are returning to downtown high-rises.
If you think about our apartment strategy was to go buy 1- and 2-story buildings, exterior entrances. That's played out well if we look at the commercial office space. The Crossing Center, it's almost like you could convert it to one of our apartment buildings. Right. All these tenants have their own entrance. They're all exterior entrances.
Their own unit, HVAC, etc.
Yeah, so you see here, what this chart is showing us is from January 2019 to June of 2021. And this is the weekly traffic or weekly people that have a cell phone. Now, if you don't have a cell phone, you're not going to show up on this number, so please go buy one. So from January of 2019, how many people came each week to this location? And you can see there's a little bit of a drop in the middle of 2020 there, but it came back almost to full. Remember, Josh mentioned it's only 85% occupancy. So there were some businesses that were lost there during this. But at the lowest point, it went to about -70%. And then it's climbed back to about -15%. And it did that by October of 2020. And then since then, it's kind of been flat going across. And you see these two drops that we have right there. Those are Thanksgiving and Christmas, those weeks. So in this location, yeah, people aren't going to be there those weeks. So this just shows us exactly kind of what's happening at this location. Now, if we compare that to the opposite of this type of an asset is kind of one of our favorite buildings in Atlanta is 191 Peachtree. It's right downtown. When I was back at Deloitte a dozen years ago, our office was there. Our current attorney is there. So we speak to them a lot. And there's also a Ritz-Carlton there that has great jelly beans. So if you're going through, that is a wonderful building. We like going there, but not, the chart's not showing that other people are feeling the same way Josh and I are. So you can see right when COVID hit, I mean, they were down 95%, and it stayed down 95% for a while. October, they were only back to -70%, and they're still down 50% in that asset.
Yeah, one interesting piece, Dominic, is it possible to go back to the previous slide? So, and you see the recovery here it was about a 4 to 5 month window. That basically the bottom was April, and basically went to about 85% recovery in October-ish. So give it five-ish month window, and we go back to kind of the downtown. And number one, it hasn't had much of a recovery. It basically dropped 97% and has recovered about 20% of it. But that recovery is very prolonged and really didn't start until January, February of this year. So one of our theses is that that suburban office would do very well in this new environment compared to the downtown high rise, and this foot traffic data is telling us that's true. Yeah,
and downtown still has a while to go before it's coming back. If it's, you could see, do you think it's really going to get back to 100% ever in one of these types of assets? And yeah, the majority of people that go to 191 Peachtree, this office center, they're commuting in. So
it's professional services and Yeah, it's a lot of the
So-
work from home concept, much more here so than the suburban office.
So the next part we could look at here too is even more granular into the data that we have through this. And this is what days are people coming and how long are they staying at the location. So Crossing Center 2, you can see Monday through Friday, people are going. Saturday and Sunday, not so much. That's a little, not quite as much happening on the weekends there. And then we look at the bottom part here, and this is, it might be a little small to see, but this is how long is someone staying at the location. So that green arrow is pointing to people that are at that location all day long. And then number of people is, so also we've got people coming for, under 30 minutes, 30 to 45 minutes to an hour. So we got a lot of people that are there all the time and a bunch of people that are coming in and out. And that's indicative of what we want to see from a medical office center. Like you want to have your people there. You also want to have a good inflow of people coming in and out on a daily basis. So we can see that from this. And a benefit we could have, and what we're using it for, is comparing one medical facility to another to see like, okay, what does that really incremental foot traffic look like to determine which one's performing better. We can go to a medical place and be like, wow, it looks nice. There's people here, but it's performing better if we know there's customers coming there. And that's what we can tell from this Placer AI data. So we're very excited about using this, and what it's helping us do is make more proactive versus reactive decisions on our investments. With this, we can not only see a property, we looked at Crossing Center 2, and we can see, hey, what property is back to this threshold? We can then go pull all office centers that are back to a certain threshold, or all medical, or all one brand, and see what's the top performers. And let's take that information that we are looking at specifically and get that out to our brokers or our acquisition team to go find those deals and go after those deals, as opposed to waiting for them to come to us.
It saves us a lot. I give an example. A couple months ago, we were looking at a government list deal in Huntsville, Alabama, and we were really excited about it. It had a long-term lease. It really checked all the boxes of everything we've been looking for. So got in the car, drove our 3.5 hours, get to Huntsville, 10 a.m. on a Tuesday. There wasn't a single car there, and there was no signs of a car ever being there, like in the last 6 months. So I asked the broker, like, hey, where are the people? It's like, oh, they've been working from home. They're probably not coming back. They had a long-term lease, but there was a high likelihood they were going to cancel that lease in the short term. So we ran away from that deal. This, if we had this, we've recently signed up for this in the last 90 days. We had this 6 months ago. Would have saved the whole trip to Huntsville. So we were excited about using this for acquisitions.
Yeah. So now we're going to look at our commercial properties and see how did this impact things as a whole. So going back all the way from the inflation kind of component to our people back to work, and what is data looking like. So here you see our overall occupancy. We're up again this quarter. We're now at 75% almost across all of our commercial assets. Now, it has helped that we acquired deals that are occupied, so that's a little bit of a skew there. So, but we're going to go through this left to right and walk through it. On the office front, with all of our deals on the left side here, our spec space is this part that's not leasing well. We've mentioned that before. We have to a mixture of lowering spec rents and starting to do those build outs so we can get people to move in. Ready to go space, most of the businesses we're talking with are in that K-shaped recovery. They're the ones that are doing well. They don't have time to wait 3, 6, 9 months to go build out a space. They want to move in right now. They already feel like they're behind. So we have a lot of the tenants that are in that camp. So that's obviously not great for spec space, but it's great for currently built out space. You see our occupancy gains here at TVTC. This asset, we reported going into Q4 of 2020, we had a publishing company that was leaving, and that was just over 10,000 square feet. And over the time frame since then to now, we've been able to backfill that with, surprisingly, logistics and e-commerce based companies. So they're taking up that space, and most of that is expansion of current tenants that are taking that. So we're spending some TI dollars there. We'll go into kind of where we stand on reserves and stuff, but we had occupancy gains at TVTC, and you can also see in the station, we've had some slight occupancy gains here. This one, we have smaller tenants, so our occupancy gains weren't as large here, but we're still gaining on what's going on here.
Yeah, and Dave mentioned that the expansion of current tenants. That's a big piece of our strategy. When we're buying these properties is if we have any vacant space, go to the current tenants and incentivize them, give them a sweetheart deal to expand into the vacant space, because they can do it quicker, they can make decisions faster, and it enables them to be stickier to the property. So that's played out for us really well at TBC. It's played out for us at Park Lane. It's played out for us at Parsons as well.
Yeah, we look at jumping into our medical stuff here, and this is showing our occupancy in the second quarter versus the occupancy in the first quarter. So we had 3 properties that had gains, being TVTC, the Station, and Summit. Now, when we think about that strategy that Josh just mentioned on the medical side, almost all of these deals, Park Lane, Summit, Parsons, Palmetto, Pediatrics, these are all deals that we bought that were not fully occupied in that, well, most of those were about 80% occupied at the low end. So they're more, it wasn't like they were 40% occupied, 80% plus occupancy. And we really spaced in all of those buildings to existing tenants. It was like, hey, you've got a great functioning practice. Why don't you take this other chunk and add it into what you're doing? So that's how we've been able to gain occupancy on those last 5-6 deals, is all around current tenant expansion. So our medical demand continues to be strong. We're very excited. We're still bullish very much on finding more assets that we can do in that slightly unoccupied and drive expansion there. On the retail side, you only see two there, but we've got 9 retail deals. They're all fully occupied. They're all fully paying. They were occupied last quarter and they're occupied this quarter. That's been a very solid performance component of our business. And with the placer data, we're looking for more and more opportunities to buy those assets and realize current cash flow.
Yeah, even with the one hiccup we had in retail, we basically have bar/restaurant in Midtown Atlanta. Basically the tenant vacated late November, early December, and we signed a lease for a new bar/restaurant concept in mid-January. It took us about 30 days to find a new tenant that paid 4 months of rent up front, and we were off to the races again. So
yeah, so from renting a restaurant in the middle of kind of a COVID pandemic, it went pretty darn quick like this. So that was still a little bumpy. That was the 330 Edgewood, the Black Sheep deal that's in our triple net fund, but it turned out very well. All right, so we're going to jump into this next part here and say, like, okay, from that occupancy gains we're at, how does that look for our cash reserve position? So we're going to walk through just how we do our cash reserve calculations and where we're at right now. You can see kind of our bar charts across a couple of these different deals. But one part on our reserves, we tried to develop a reserve strategy that ties specifically to how we're operating. So what that means is if we have a deal that did exactly the same quarter over quarter over quarter, we're going to have exactly the same reserves quarter over quarter. If we have deals that are having higher turnover, or we're having expense control issues, or anything like that, we want to adjust our reserves to be able to accommodate for those variabilities. You've got to keep in mind, mostly all of the deals we're buying them from people that don't have cash in that asset to execute a business plan. So we want to avoid that situation by making sure we actively manage our reserves to match what the business is doing. That's why we could say, like, hey, we're on track with the reserves one quarter, then how does it change the next quarter? It's like, wait a minute, what the heck happened? So thinking about that standpoint, we have our reserve threshold of $2.25 per square foot on a deal. So if we got 100,000 square feet, we're going to reserve $225,000 for the year. That's a pretty static number. The things that change, though, the taxes. We appeal and negotiate our taxes with every county and city all the time. So that is not a once a year kind of conversation. That is a weekly, every week we deal with that. When we get new tax rates, we adjust what our financials look like. So our tax rates can go up. Sometimes they go down, actually, which is good too. But those can change. Same with our insurance rates, and then mostly our OpEx costs. So we're taking the current 3 months. So if operating costs go up in one quarter or go down, we adjust our reserves to accommodate for that. So our reserve is not just a fully static number. It is an aggregate of those 3 things, which can be variable. So if we look at going left to right here, we start with TVTC, and we're showing right now that we're 53% of our reserves are met. And this is our goal for the year, is 50%. we're at 53% of it. Now we know in the second quarter, we leased a bunch of space. We also paid leasing commissions on some of that stuff as well. You can keep in mind, every one of these bigger tenants, especially, one of our tenants at TVTC is Shaw Industries owned. But Tricycle is owned by Shaw, which is owned by Buffett.
Oh, yeah.
And Berkshire Hathaway. So like it goes up a chain to a pretty big player. They all have brokers when they're negotiating all their stuff to expand. So even though it's a couple thousand square feet, they all have a broker and a leasing commission that's involved on that side of it. So that's in there. So we're paying leasing commissions, and then we're also reserving for the TI that we're spending there. So we see our reserve number there, we're at 53%. If we look at Lupton and North Graham, these are both construction projects. So we typically don't recapitalize our reserves until we're done with the construction project. And we will refinance those once we're at, once we know we can get the best debt.
Right.
So that's,
Usually around 85–90%. And then talking about construction projects, the station, Johnson Square, even the 1824 and Summit, these four properties were either recently acquired or they still have open construction, and we're constantly balancing, basically managing that construction spend, paying the bills, and drawing the new loan. So, for example, at Johnson, we just closed in January. Our reserves were full in January, but now they've dropped to 44%. It's not because we lost money in that time window, it's because we just paid a bunch of leasing commissions that we paid out of cash instead of drawing up the loan. Because we're in lease-up mode, we were trying to keep our carrying costs lower, so we use our cash reserves instead of drawing up the loan. So you'll see any open construction project is going to have highly fluctuating reserves as we go, because we're going to be balancing carry costs and spend as we go. And until they're stabilized, like a Baco, M&G, a Park Lane, a Parsons, these are all stably operating.
all the way across.
Yeah, all the way across. There's not too much construction activity. There's no loan to draw up. They're just flat.
Yeah, at Johnson, we have about $1 million on this loan. We didn't sign any leases in June. And if you remember our last quarter, when we talked about Johnson, we're like, look, if we don't sign any current leases in June, we're going to proceed with our mechanical upgrades. We have about $250,000 of HVAC repairs to make, and that's replacements and improvements. Keep in mind, there's like 130 HVACs is a big complex. So it's not like, we're getting a lot of HVACs for that amount of money there. But then we're also spending about $750,000 as we upgrade the exterior. We're doing fresh paint. We're doing windows and door work. Same thing as we had done at Park Lane. We sent some videos out of Park Lane before and after, and it looks like a totally different asset once we're done with it. So we're excited to see that change. And throughout that process at Johnson, we're going to balance our cap spend with a loan draw to see what we're, to reduce our expenses as much as we can.
And that should really go on over like at least 12 months, or maybe even a 24-month period, that we'll have some quarters where the reserves are really fully met and we're distributing, and other quarter, and that's based on really our drawn leasing and CapEx schedule.
Yeah. So then if we jump into the medical part here, so you see a couple of these are all full, and if they're full, that means they made a distribution. And our distribution strategy, anything above that number, we distribute. That, we're going to do, it'll be all prefs. Eventually, if it hits into profits for the year, that'll be in profits. But any amount of dollars above our reserve, we're distributing. The ones we don't have, 1824, right? We're showing we're at 70% here. We have about $200,000 of renovation and repair work that we're doing on this project. We're going to spend that, and then we're going to draw that out. So as we finish that, our projections are when we're at the end of it, we'll be fully reserved and ready to go. We're just right in the middle of that right now on 1824.
You're close in March.
Yeah. So you see two of these other gray lines in here. We've got the Crossing Center 2, which we touched base on, and the 6160 deal. Those are going to come on, and we'll have reserve thresholds. We just closed those, so they're kind of Q3 deals. They're not Q2, but those will be in there in the chart going forwards. When we go over to Summit, that's the next one that we have. This one, we still have a good amount of reserves here, but we have been doing work on this asset to get it fully leased. We're, on the previous slide, you saw we're 100% occupied, but that took us spending TI and leasing commissions to get people in there. And the last one, Parsons, well, I guess not last one, still got like 15 more to go over there. But Parsons is exciting. We're fully reserved here, and we just got a tenant. We weren't fully occupied. We have 2 open suites there. We just got an existing tenant to expand into one of those suites, and they signed a 7-year lease. So our occupancy over there in Q3, we're going to see another bump from that. And we are fully reserved, so we have all the money to do everything we need to there. So we're in very good shape. Palmetto, this one, it's in Anderson, South Carolina. And this stems from when we purchased the deal, we did a renovation to split apart some tenants. And then in the middle of this also, we had a tenant, our first one now, that said that they do not plan to renew, or they do not plan to keep their lease once it expires in about 12 months. A lot of the times, when we hear like, oh, hey, a lease is going to expire, there's a sense of nervousness. And we've been doing very well with leasing our medical space. So we are going to have costs associated with that, but we're pretty optimistic on filling that space and getting higher rents.
And they're 2,000 square feet of 12. So it's impactful, but the deal will still be well over 80% occupied.
Yeah, that's a good point on the size of it, with it only being a little bit less than 20%.
Right.
So, and then pediatrics, this is another example of a deal that we bought. We got the current tenant to expand, and it's fully occupied. Yep. And it's chugging along and doing great. On the retail side, I said everything's full, all reserves are met.
Pretty straightforward.
Yeah, it's pretty straightforward on that one, and they all distributed. So we're in good shape on that one.
Yeah, one interesting, I don't know if we're talking about here on the next slide, is about our average weighted lease on the retail side, on how long it is.
Yeah, we touched it. Yeah, we're going to jump into that as we look at like, okay, how much funds was distributed on the retail side. Our lease average is about 48 months.
Right, which is fantastic.
So yeah, we trying to think of the most. We signed the Grapes and Greenleaf, which is a 10-year lease, but most of our leases are 5-year leases. So it's like the highest it could ever be is 60, and that's if we bought all the deals at the same exact time with a 5-year lease. So being at 48 months is pretty darn high. Statistically, I don't even think we could get to 60.
Right.
There's no way that's going to happen. So 48 is very good. Yeah. But this right here, you see our distributions of where we're at, and you should have received all of these. Dominique, they were now
30th.
on the 30th. All of those should have hit. But you see the different amounts that went out. And the reason it's not even is because, like we said, whatever cash is above that reserve threshold, we're sending that out. So these are all of the deals currently that went out. And we're still in this mode of prioritizing reserves. We mentioned this too, like we are buying from owners who do not have cash to be able to execute a business plan. We get stuck in that kind of a cycle. It's very hard to come out of that on a commercial asset. So our key priority is make sure we have our reserves in place and we're operating strong so that we can make distributions and we can fulfill the business plan of the deal. So yeah, anything to add on these ones?
No, yeah, they're doing great. The Dave's point on buying from owners that don't have the cash, it almost seemed too simple on the last asset we bought, which was the 6160. They literally had 3 leases in hand waiting for the tenant improvement dollars. The property's sitting there 40% occupied. All the owner had to do was commit to spending that money, and he would have been full and sold it at a higher price. But we're talking several $100,000. So we come to the table with the extra money and happily willing to spend it to be at a lower basis.
Yeah,
so,
even like the pediatrics deal, that's a deal where we, there was one tenant there, they occupied 90% of the building. It's like there's only 10% left. Like we'll build it out, make it nice for you, and just move it, add that into your space. And they're like, oh wow, you'll just clean up so we can use it. Like, yeah. And then they agreed to pay rent for it. So we're probably making it sound simpler than it is, but that was a longer conversation to make all that happen with our team. But it's a pretty easy thing to conceptualize. Like, hey, let's just get them to expand and do the right thing to make the space usable. And there are willing people to take that space and move in right now. So we look at opportunities in the commercial space for 2021. We kind of look at these four segments: medical, retail, government, or this new one we've been working on for about 12 months now, which is the industrial, the flex space side. But on the medical side, really just what we've been talking about, continue to see these mixed use or partially vacant spaces that we can build out, and occupy better.
Yeah, one of our upcoming deals that we'll talk about on the next slide, but it's 50% leased to medical, and the other, it's a 4-story building, two floors are leased, the other 2 floors are just waiting for someone to offer the money. So again, we'll buy it at a discount, we'll offer the money, and we'll be in an overall higher cap rate and a lower basis than really any medical in the area, because we offer it, because we bought it.
Yeah. So essentially, like if we buy a deal, offer TI dollars, that combined price, we're then owning the deal at a higher cap rate than if we were to just
buy
a stable deal, right? It's like, so that's the strategy we're seeing in medical.
And a lot of the properties we're buying are in the one that we're looking at in Chattanooga right now is basically on the hospital campus. It has active demand for it right now. So it's not like we're buying and say, hopefully people will come in a year or 2 from now. They want it, they're waiting to get in the door. They just need someone to offer them the money to build out. Their business can't afford it, and the current owners don't want to supply it. So those are the kind of properties we're looking at.
Now, on the retail front, we've got 2 kind of strategies. One, we talked a lot about that data front. That's really driving our decisions to make sure we're buying not just a Dollar General, but the right Dollar General or the right Zaxby's, or how we're finding those opportunities. Another part of it is kind of moving upstream. Instead of saying, hey, we're just going to look at deals, we're now partnering with operators to say, like, hey, let's piggyback with this guy or team that can operate a bunch of Zaxby's or operate a bunch of one brand, and we partner with them, and as they grow, we be their real estate partner. So we have a very good relationships with Zaxby's operator right now that we're doing that with. We'll have more information on that deal coming out, but we like that cycle in the retail front. It kind of gets ahead of the curve, being proactive versus reactive to what comes out. And then on the government front, it's kind of similar to the medical front of finding deals that we can expand.
Yeah, and the other nice part about the government front is we're normally able to buy them at a lower basis. The government's not normally paying top dollar rent; they're normally paying lower rent, which equates into a lower cost of building. So I think general metrics, if you're to like Google the likelihood of a government renewal, I think it's somewhere in the 97% range. So number one, we think we're in a pretty safe position with the government tenant. And number two, if for some reason we're not and that government needs to vacate, we own the building at a much lower basis because the rent has historically been lower, that if we do need to turn it, our basis is still in a solid position. So we really like these government deals. We have a big one coming up that we'll start fundraising for about 2 or 3 weeks. That's here in Marietta, Georgia. It's leased, it's 70% leased to government tenants. The IRS and Department of Defense are the 2 big ones there, and they've been there for a very long time. They have they have 6-7 years left on their lease, and we think it's in a really great position.
And when we talk about government, like we've been doing government for a while. Our TVTC deal that has the state of Tennessee, we consider that to be government because it's a state or local or federal agency. Also, our VA clinics, we bought a couple of those now. They're a mix between medical and this government segment. So when we talk about government, it's that kind of thing where we have some kind of state or federal backing that's going into it, and they could also fall into be a medical tenant on that front too.
Right, exactly.
And then industrial flex, we're actually doing a webinar in maybe a month or so, or 2 or 3 weeks here, building out more on just what our overall strategies are for the different asset classes. And this one is one that we've been studying and working on heavily, learning from our tenants that are kind of like the logistics, the e-commerce, those growth segments, and saying, like, hey, let's look at some assets that are specifically geared towards that segment. It's been doing very well.
Yes. Yeah, the theory, the Amazon effect of the just-in-time delivery and the last mile has had a major impact on this segment of real estate, and that we're looking for opportunities to be part of it. So we really like if you were to conceptualize it, you go in, you kind of open a front door of a building, there's 1,000 to 2,000 square feet of office. Then behind that, there's usually 3,000 to 4,000 square feet of warehouse with a roll-up door in the back. So that's the kind of property that we're looking for and kind of a mixture of that.
Right. So we're going to jump into we'll show you some just quick pictures of what these opportunities are that's coming out. As we wrap things up here, we're going to do Q&A. Dominique's going to talk about, we're going to do live streams for these opportunities when they're fully live. We just got some nice pictures right now of what they look like. But we'll have all that information out to you as well. So I'm going to turn over to Dominique now. She's going to walk through this part. And then while we're going through this too, if you have any questions, make sure you type them in there, and we're going to go through all the questions and stuff that there are now as well. All right, Dominique.
Thanks, Dave and Josh. This is a friendly reminder that this concludes our regularly scheduled program. And before we do move into the Q&A portion of this broadcast, we wanted to leave you with a few upcoming dates for you. First, we closed out our second quarter and shared with you our quarterly newsletter, along with end of quarter reports, July 28th. And any applicable distributions should have already settled in your account by July 30th. We have a busy third quarter ahead of us with many exciting new opportunities for you. And we have our upcoming live stream schedule here on the right. Don't worry, the email that shares the recording link with you will have all of registration links for these upcoming opportunities. But let's run through them very quickly. August 19th, we actually have 2 live streams for you. We have the Zaxby's live stream where our panelists will discuss the ins and outs of the deal. And then we have our Greenleaf investment strategy presentation. Our panelists will discuss what Greenleaf looks like in deals regarding in the future and what we intend to buy up and coming for the remainder of the year. So we're super excited about that, and we invite all of you to attend. August 26th and September 16th, we actually have 2 government office deal presentations for you. On the 26th, we will discuss 2300 Lake Park, which was what that government deal located in Marietta, Georgia that Josh mentioned. And then we have the state of Alabama, where we really are breaking into a new market, Huntsville, Alabama. So we're super excited about that. All right. Thank you, everyone, for joining us today. We will dive into our question and answer portion of this broadcast. So I will hand it over to Natalie, and we will begin answering any questions you may have.
Thank you, Dominique, and thank you to everyone who submitted questions. We also want to remind you, like Dave said, to continue using the Q&A feature at the bottom of your screen to submit questions as we work through those that have come through so far. So we'll dive right in. First, are we seeing non-paying tenants or an increase due to COVID-related reasons?
No. Yeah, all of our COVID issues were probably settled in kind of that middle of Q3 of 2020. The only thing we actually have seen is we've bought some deals. Obviously, since COVID, we bought a bunch of deals, but those tenants that had back owed COVID concessions are now paying us. So we have a little bit of a bump in revenue, which has been nice, kind of unexpected, but yeah, we haven't had any commercial tenant COVID discussions or issues for 3 quarters now.
Do you foresee any future eviction issues?
Eviction. So we haven't had any. We talked about that one tenant we had, the bar restaurant, more bar, in downtown Atlanta that we had the eviction with. Other than that, we haven't had any, and we don't really foresee any future stuff happening right now.
Okay. Are you looking at the possibility of another lockdown or preparing for that in any way?
Are we preparing for it, or what was it?
Are you looking at the possibility or preparing for that?
Oh man, that's there are varying degrees of political issues going on with the whole lockdown component, but I think one aspect on how we're operating as a business, and Josh and I leading the organization, we have investors that we need to communicate with effectively and make sure that we are doing things safely and executing our business plan. We have 80 team members and their families that depend on us for making good, safe decisions. And then we have our resident base that wants to know that we're doing a good job too. So whether there's either lockdowns or health concerns or whatever that may be, we are going to operate in making the best decisions for the segments that depend on us. Whether there's going to be an actual lockdown, I don't know. There's a lot in the news right now. If you think of just like the 4 biggest states, New York, Florida, Texas, and California, and kind of what those governors are going through trying to handle both sides of the aisle. And I'm happy,
Extreme.
yeah,
one side's
I'm
saying
happy I'm not in
lockdown.
their suit right,
Yeah.
suit right now. So that's definitely a challenge, but Georgia, we were kind of last.
Yeah, we're kind of the last, to close and the first to open. I think our lockdown lasted just under 2 weeks. We tend to align, for those who are not familiar with the Southeast, in terms of politically, we tend to align with Florida and Texas very, very well. So if you watch the news or follow kind of what's going on there, our governors in North, South Carolina, Tennessee, and Georgia usually kind of follow, what's going on in those other states. They get a lot more attention than we do.
Yeah, the part we are kind of preparing for and thinking about going into Q3 is back to school. We know with back to school, there's going to be, the biggest part of COVID too is childcare, and how are people going to work or be home, or how's that going to work? So we are preparing for that, and knowing that, look, there's going to be a bunch of unknowns. We have to be flexible with how we execute a business plan. Right now, this whole pandemic would have been different if it impacted kids more severely. But I think right now everyone's planning to go back to school, right?
Yeah.
All the schools here are open, and they're all planning like send kids back to school. So that was really the biggest logistical hurdle we faced, was like, if every kid has to be home, how do we do that?
Personally speaking, I don't know how to do that.
Yeah. So but that's something we are preparing for, and we handled that very well on the first round. So if that does come back again, we feel confident we can execute with our business plan with that happening. Our businesses, that our tenants, have already gone through that as well, and we feel like the weaker links have kind of been eliminated from that in our portfolio. So we feel like we're in pretty good shape, both organizationally and tenant-wise, on where we're at there.
Okay. Our next question has to do with funds. Outside of the triple net, is there any discussion of Greenleaf creating any kind of commercial fund?
Not really at this time.
Yeah, and historically, we've done kind of mini funds where there's basically a unique opportunity to buy a group of assets that are similar type of properties in a very, short time window. We'll likely do that in the future, in kind of unique opportunities. But we Dave and I were talking about this yesterday. We really like the flexibility of doing deals one off. It provides the business flexibility. It provides our lenders a lot of flexibility. It provides our investors a lot of flexibility to kind of pick and choose and be involved where they want to be.
Yep.
We have some property specific questions, with the first regarding Parsons. With the occupancy level still at 85%, do you see lowering rental rates to fill it up?
Really just that one suite, right?
Yeah, we have one suite that's left. So it's more, it's not just the rental rate, it's also ties into what TI package we're going to do and who's going to fit in a 3,500 square foot space. And then also, since it is a large medical complex, not only our building, but all the other tenants that are there, like, you can't double up on tenants. So we can't have, we wouldn't put a dentist in our space and then put another dentist right next to them. Like, it doesn't work like that. So most of the medical tenants all have essentially buffers that, hey, look, we want to be the only tenant in this complex. So Parsons is pretty darn full. So right now we're looking at like what tenants are not there, and we can go attract those tenants and move them in there.
Yeah.
So we actually have a tenant from Parsons that opened another location with us in Johnson Square. So we're going through our tenant base and talking about all the tenants we have, and like, hey, do one of you want to open a location in the Parsons complex? It's a great submarket. So it's not necessarily the rent dollar amount, it's more the finding the right tenant that needs to be in that space.
That's one huge benefit of really kind of having decent penetration in the market, especially the size of Atlanta, that we have properties on the northwest side in Marietta, like Johnson and Crossings, and we also have properties in Johns Creek and Duluth that those are two completely different markets. That take from one to the other takes about 45 minutes. So you can't have cover. If you want to cover both those, you have to have two different offices. So we can play off those markets and basically occupy more space. Going back to the question about dropping rental rates, to Dave's point, it's much less sensitive of the rate, much more sensitive of basically who fits in the space and the TI package. So rates are kind of third, fourth, or maybe even fifth priority when talking to tenants, when all those other things I just talked about are higher priority.
Okay. Our next question has to do with refinances. Given lower interest rates, which properties, if any, do you plan to refinance this year?
This year. Well, so most of them were purchased relatively recently. There's in the last 12, 24 months. TBDC, we've owned the longest. We did a 10-year fixed rate loan at 4.1%. Our Parsons Park Lane VA deals are all locked in the 2.6 to 2.8% range. We've done an incredible job at locking long-term interest rates. It's really the renovation properties that need lease up and need seasoning, and that's going to push us.
Yeah, and that's Lupton and the station that are two lease ups in 1500 North Graham. So, and those aren't necessarily like fully occupied. Like once we have concrete leases and agreements, we can start the refinance process there. Just like we did at Grapes and Grain, we refinanced Grapes and Grain before we finished the renovation because we had the lease in hand, signed and executed. So we would do the same on those three assets, being Lupton, the station, and 1500 North Graham.
And from a rate standpoint, we can look at the math behind it, but our average rate on our office properties is probably just below 3.5%, with several of them below 3%. That was the ones below 3% were a really unique opportunity that it was just timing with COVID and the treasuries, and it was really just the perfect storm of low interest rates. Now rates are in the kind of 3.25 to 3.75 range. We really only have one asset, which is TBDC at 4.1. That's above that range right now, and it's 10 years fixed money. So we really don't have any that are kind of highly priced rates.
Okay. Our next question was partly answered in the discussion, but in a situation where a current tenant is leasing additional space, did they lease it at the same dollar per square foot that they're currently leased at?
No. So it's no. So they're separate leases, and basically what we've done in a situation like TVTC, they had two leases. They leased a third space, and we adjusted all the leases to then end at the end of 2022 and then be combined into one lease. So they're typically signing an additional lease, and then we're typically matching that to an existing expiration, and then building a combined lease at the end of that they have the option to take. The rate differences, typically we're either doing something with TI or we're doing something with a month or two or three of free rent as we negotiate that component. So, there's kind of like that net rent that we're actually getting versus like, hey, what's your rent per square foot on the gross level?
Makes sense.
But no, they're not the same.
Our next question is QOZ related. What is the plan to increase occupancy on the QOZ properties? There doesn't seem to be a lot of movement.
Well, so the QOZ fund has three aspects, and we're actually doing our residential live stream in about an hour after this as well. But the first three deals we bought in the QOZ fund were residential, and the last three we bought were commercial. And the commercial ones are really like finishing up that renovation. The station is the only one we're done with. We have some spec space to rent that. The option we're strongly considering right now is our office, where we're sitting right now, is in one of the classic spaces at the station. And we just signed a lease here for $17 a square foot with a new tenant. And Josh and I, no, we should probably just move out of this thing and rent this for $17 a square foot, as is someone else. And we would go do the spec space or move there and just make that work to occupy that space. So we're looking at that option on the spec. For North Graham and the Lupton, those are, done with their kind of like the heavy lift part of the renovation. And we have brokers working diligently on both of those deals. We've gone through a couple offers. We have one we're negotiating on Lupton right now. We have one that we've been negotiating on North Graham, but we don't have anything concrete that's moving into those spaces. And again, the spec space right now is just, it's taking a lot longer to rent that stuff.
Right. So one of the things that we could do if leasing traction doesn't pick up is build out part of a spec space or build out a whole floor. The challenge with building out spec space basically into another layer of spec space is that you're likely going to have to make adjustments and modify again when you actually sign that lease. So we're hesitant to go and build out too much because we know we're gonna have to change it again for that tenant. But we also are cognizant that we probably need some model unit to show off. So for people to get their head around.
Yeah. And at Lupton, we've been focusing on renting the first floor. So when you walk in, you see occupancy right away, not renting the fourth floor, which no one's gonna ever go to because it's unoccupied. So we're in negotiations for that first floor space that we get people into soon.
We have another QOZ question. Based on the status of the renovation and lease up plans of various properties in the fund, when do you think investors will see some sort of cash distribution?
So I mean, we touched base on this a little bit in the QOZ end of quarter, which was maybe like July 15th or so, but we technically can't distribute cash until we recognize basis, which won't be until 2025. So I know that sounds like a long time away from now, but the QOZ fund, part of that was we're going to pay taxes in 2026. And then to pay those taxes, we're going to recognize basis with a 15% discount. So we can't really return cash until we have basis to return, or it all counts as profits. And I don't think you want to be paying taxes on that. So right now, the goal is to pay out distributions in 2025 to cover all the tax liability. And then we're also optimistic by 2025, we will have earned up our basis through cash flow. Now we can make positive, if we have positive basis, we can distribute positive basis. And if that doesn't make sense, we can do a phone call on that one and kind of explain what that means more.
Great. For our last question, are there any other classes of commercial you see Greenleaf moving into?
Not hotels.
Not hotels.
We're very much an operator of real estate. So we're leading with how we're going to operate this and where do we see that opportunity. So we're doing everything from we buy the deal, we execute into leasing, we do the maintenance, we operate the deal, we do the accounting for it. So we want to do that full vertical. So we'd really look at any asset class as long as we can find a consistent strategy that we're able to deploy with buying an asset that's undervalued, adding value to it, stabilizing it, refinancing it.
Wonderful. Well, we will stay on the line here for a few more minutes in case anyone has some additional questions. Again, use the Q&A feature at the bottom of your screen. In the meantime, we want to thank everyone for all of your great questions. And of course, we want to thank Josh and Dave for sharing these commercial updates with us. As we wrap this up, we'll leave you with our live stream schedule here on the right of your screen. Dominique's going to put this up for us. And don't forget to check out our Greenleaf Connect YouTube channel for all of our recorded live streams, with this recording being made available tomorrow. This does conclude our end of quarter commercial broadcast. We certainly appreciate you joining us today, and we hope you join us here on our upcoming live stream here in about an hour. Dominique is actually going to message everyone now with the link to register in case you haven't done so already. But again, we'll stay on the line here for a couple of minutes, but if you're going to drop off, thanks again for joining us and enjoy your day.